The IRS announces how much you can put into a tax-advantaged retirement account each year. For 2026, it names a pair of figures. Into a 401k, $24,500. Into an IRA, $7,500. The gap between those figures is where the question goes wrong. A big ceiling sitting next to a small ceiling looks like a contest, and a contest invites you to pick a winner. The IRS publishes a separate ceiling for each of them. A traditional 401k arrives through your employer, funded by salary you defer before it is taxed. A Roth IRA is an individual retirement arrangement held in your own name rather than through a plan and funded with money the government has already taxed. Separate ceilings, separate rules, one paycheck feeding both. So the useful question is one of order. Which account gets your next dollar? The mechanical difference between them is the whole video. Traditional 401k money goes in before income tax touches it. Your taxable income for the year drops, and you settle with the government decades later on the way out. Roth money has already been taxed on its way to you. The IRS puts it plainly on its own page. You cannot deduct contributions to a Roth IRA. In exchange, qualified withdrawals later come out tax-free. One account hands you a discount today and a bill in retirement. The other charges full price today and settles the bill in advance. People run that comparison with enormous confidence. Slow down at that point because the answer swings on your tax rate in retirement, and that rate gets set by legislators who have yet to hold the vote. Treat every confident answer you hear as a forecast, wearing the costume of arithmetic. The workplace side has a feature worth naming first. Some plans add employer money to your account when you contribute. I am deliberately skipping the match rate because it varies by employer, and your plan's own documents are where that detail lives. The part I want to spend time on is this. Employer money can land in your account while still belonging to your employer. The IRS has a word for how much of an employer's match belongs to you, and the word is vesting. Vesting means ownership. Your own contributions are yours from the moment they land, every time with no waiting period attached. Employer contributions can be put on a schedule instead. The outer limits the IRS permits are longer than they sound. Under the longest cliff schedule allowed, you can own none of the employer money until you have been there 3 years, and then all of it lands at once. Graded vesting spreads it out. At the longest schedule allowed there, you pick up 20% more each year from year 2, and you own the lot after 6. Your own plan can be faster than either, which is exactly why you check it. 6 years is the outer limit a 401k can make you wait for the employer's money. If your plan uses one of those schedules, changing jobs every couple of years can leave some of that money behind. A match where you have one is employer money. It comes with a condition. The condition is written down, and you can go and read it. So before you build a plan around employer money, go and read your own plan document. Back to the pair of figures from the top, because it is easy to read them the wrong way. The workplace ceiling for 2026 is $24,500 of your own salary deferrals. The IRA side is capped lower at $7,500, and that figure covers every traditional and Roth IRA you own put together. Opening a second account buys you a second account and the same single limit. Turn 50 and both figures rise. An extra $8,000 on the workplace side, an extra $1,100 on the IRA side. On the workplace side only, many plans let it rise again in your early 60s. Now the deflating part. Hitting the workplace cap means diverting $24,500 of salary in a single year, on top of rent and groceries and everything else. If that is off the table this year, the ceiling is describing somebody else's constraint, and falling short of that ceiling is nothing to feel bad about. If that is where you are, the ceiling stopped being your constraint a long time ago, and what you can spare each month took its place. Once that is true, the ceilings drop out of the decision entirely, and all that is left is where the next dollar goes. You were choosing an order. One gate sits on the Roth side, and it can close the direct route entirely. Roth contributions phase out above certain incomes. For 2026, a single filer runs from $153,000 to $168,000. A married couple filing jointly runs from $242,000 to $252,000. Inside the range, the amount you can contribute shrinks. Above the top of it, direct contributions stop. And those ranges are measured on modified adjusted gross income. That is not the number on your payslip, so look up the real one before you decide where you sit. Go and check your own figure against those rather than taking my word for where you land. The quieter requirement is easy to overlook. Your contribution generally cannot exceed your taxable compensation for the year. One question outranks everything above. Get it wrong, and the Roth debate belongs to some future version of you. A workplace plan and a traditional IRA both have a fence around them, and it stands at 59 and a half years old. Pull money out early, and a 10% additional tax generally applies, stacked on top of whatever ordinary tax you already owed. The IRS applies that to workplace plans and traditional IRAs alike. The published exceptions differ by account, which is easy to miss. Leave your job in or after the year you turn 55, and the workplace plan has an exception for that. A first home or higher education sit on the IRA list instead. Either way, they stay exceptions, and I would not build a plan on the hope of qualifying for one. The Roth is fenced on different terms. The IRS calls a withdrawal qualified once it clears a 5-year holding period and a qualifying condition such as reaching 59 and a half. Tax-free is the reward for leaving it alone. So money you might need in the next few years belongs somewhere boring and reachable, in an account with no fence around it. That call comes first. Which brings us to the only useful output of this comparison, a sequence. This is the order I would use. Every input to it is something you can go and look up for yourself. Rung 1 is the boring one from a minute ago. Near-term money stays out of both accounts. Rung 2 is the match, where your plan offers one, because it is where money can arrive from somewhere other than your own paycheck. Then go and look up your vesting schedule, so you know whether that money is yours today or sitting on a schedule that can run as long as 3 or 6 years. Rung 3 is where the Roth question finally lives, and it lands on the bet we named earlier. Expect a higher tax rate later, and paying the tax now has an argument behind it. Expect a lower one, and deferring has an argument behind it. I cannot make that call for you. It is a read on your own career. Rung 4 is the ceilings, and if they are out of reach this year, they belong to a later version of your finances. I find that a strange kind of good news, because the sophisticated-sounding part of this question might never have been the thing standing in your way. One version of this deserves saying out loud, because the ladder above assumes a workplace plan exists. Maybe you are contracting or working somewhere that offers nothing, or between jobs. If that is you, Rung 2 drops out. There is no match to trigger and no vesting schedule to read, and the IRA is where this ladder points instead. Working for yourself opens up plan options of its own, and those deserve their own video. And the two gates from earlier are the ones that matter to you: your magi against the published range and taxable compensation to contribute against at all. Your net earnings from self-employment count as compensation, so contracting does not shut the door. So the honest answer to which one you fund first, the order depends on 3 things you can settle this week. Every one of them is a fact you can look up. If you have a plan, open the document and search it for the word vesting. Check your magi against the published range for this year. Then make the tax call knowing it is a call. The people who sound most certain about it are forecasting a number that Congress has yet to decide. The accounts were never the hard part. The order was, and now you have one. And that's the honest answer. No hype, no noise. If it helped, hit subscribe, and the next one comes right to you. Skip the noise, build real wealth. See you in the next one.